Good morning, Northstar clients, advisors, and friends. Thank you very much to all of you for attending today. We appreciate you putting your time aside to attend this webinar. My name is Ludi Cronje. I'm the Client Portfolio Manager at Northstar Asset Management, and sitting beside me is Adrian Clayton, the Managing Director and CIO. Adrian will be posing questions today to our various portfolio managers. The questions will look at our investment process and fund positioning in light of COVID-19, and we really hope you enjoy it. This is our first webinar, and any feedback afterwards would be much appreciated. Over to Adrian Clayton and our first fund manager, Mark Seymour. Thank you.
Thanks, Ludi. Mark. Thanks everyone for attending this webinar. It's great to have a chance to chat to you. I must say, 25 years of managing money in this industry, it's not often we get to talk to a cold camera and not clients and faces and voices opposite us at a table or at a seminar. But hopefully you'll get some insights into what we're thinking, how we've done, what's worrying us, what's worked, what hasn't. And it's an interesting time really in markets with COVID. Leading into this, and as COVID hit, the question that was asked often to me is, how are you dealing with it? And my response to that, and it really goes along the lines of how we're going to question the asset managers, is I always said to various clients, you know, there are different phases in this COVID. It's going in. Have you been well positioned going in? And that's just a general way of managing money. Are you prepared for events that you least expect? And then being in it, how have you dealt with it? And then coming out of it. And those are really the three phases of this episode for us at Northstar. And we'll delve into those particular areas in terms of our asset managers and try and get some answers out of them on our various funds. So I've got Mark sitting next to me. He managed money with me many years ago at PSG. He's an income fund manager at Northstar. Those clients that are invested in our income fund, it's done extremely well. It's been one of the top performing funds in South Africa now for quite a few years in the income space. And Mark's really navigated the fund superbly. And he's really been quite nimble during COVID. So let's see what he has to say in terms of the developments in that fund. So Mark, let's just start by saying how's it been going leading into COVID? You know, before COVID happened, was the fund doing well? And what was the good and the bad and the ugly in terms of the fund pre-COVID?
Okay, well, the fund's now got a track record of just short of 6 years. And over the last number of years, it's been doing quite well. You know, the 3-year numbers just over 8% annualized versus inflation, which is around about 4%. So that's been quite very favorable. And then versus peers average of 7%. So we've performed well. We've delivered a nice real return. It has been a relatively easy period for income funds, given that interest rates have been running at very high real levels. But given that environment, we've done well. And then going into the COVID crisis, obviously, you know, you never, you know, you just hopefully can be positioned for adverse events. Going into the COVID crisis, you know, we were neutral from a duration perspective. But I think where we did nicely was we were underweight credit. Credit spreads, you know, had been compressing over the couple of years preceding that. So we were light on credit, which is, you know, served us very well. We also had a decent chunk of offshore currency, as well as offshore bonds. And then, you know, also we were underweight property, meaningfully underweight property, and we didn't hold any preference shares, which actually all played into our hands.
So just listening to that, I think a key feature of the fund has been your absolute avoidance of preference shares in property for quite a while. And you know, you got the property call really right, and all of our funds had very little property exposure. Just in 2 seconds, you know, why have we been so short on property versus a lot of other managers that have been in that space? What would you say led us away from the property position, considering it's been such a dominant play in a lot of managers' funds?
Yes, it's obviously been the asset class of choice, going all the way back to, starting from the early 2000s. Over that period, we had plenty of growth unfolding in South Africa, and we had falling interest rates. So, two huge tailwinds. It was a fantastic asset class from that perspective. But certainly post GFC, property did rebound and do quite well. The management teams managed to do quite well in terms of generating decent distributions and, coupled with growth. But I think what's become apparent over the last, or over that period, is that your growth opportunities have vaporized. And you've seen that with management starting to look for different avenues. And I think to some large degree, that was, it's the first sign that, that there were headwinds. And then coupled with that, the issues that, it's obviously, it was a go-to asset class. So even though the yields on a trailing basis look quite favorable, the point is that investors were really starting to pay up for this asset class. And I think as a function of, a long period of extremely good performance. And, it was a difficult one to be underweight. I mean, over the last couple of years, it hasn't been an easy call to be underweight property. You've been really under pressure to make the call. But I think, in short, in the income space, on a risk-adjusted basis, if you looked at the numbers, even with, even if you have perfect, foresight, the point is that there were better opportunities in the low risk space to generate a good risk-adjusted return. So I think, we weren't super smart in that perspective. We just positioned the fund according to the risk-reward payoffs that were on offer.
I remember being on a panel myself with one of our competitors out there, and he made a wonderful statement a few years ago also on property. So they're similar to us, but didn't really like the asset class as most managers have. And he described the property space in South Africa as a four-lane highway in and a goat track out. And I think that's exactly what we've seen. A lot of money is flowing into one space, and as soon as it underperforms, there's no way out. And we can see there's a lot of illiquidity, and it's a really tough place for managers that are stuck there with many of those stocks are down 50, 60, 70%, even 80%. So well done, Mark, in avoiding that. Just in terms of being in COVID, and as we went through that episode, just briefly, what did you do in the fund? So your fund was de-risked. Like if we have to summarize what you're saying, you de-risked the fund relatively going into COVID. Not that you knew there'd be a COVID, but the fund was quite low risk. Then we had COVID. What did you do in the fund? And net, did you up-risk the fund, take advantage of asset classes that had sold off heavily, or did you de-risk? And I ask that because a lot of managers in an event often de-risk. And that it could work out perfectly, but often that's a disaster. What was your approach? Did you de-risk or did you increase risk?
Through the crisis, what unfolded was a dramatic sell-off in basically all the different asset classes, and including the rand. So one of the first steps that we took was with the sell-off in the rand. There was an opportunity there to take profits, and we deployed that into fixed bonds. Given that those yields had sold off so aggressively, obviously the risks had escalated as we've come to realize.
So the 10-year went to what kind of yield?
Well, the curve, the long end of the curve went way above 13%. So we saw in a very short period of time a dramatic sell-off in yields. So there was that opportunity which made a lot of sense. And we didn't go very long dated. We bought primarily 186 bonds, so it's a 6-7 year bond, which were trading on very attractive yields. So that was the one step that we did. The next step was that we also the fund was quite nicely liquid, and coupled with the senior bonds that we held in the floating rate note space, specifically after the interest rate cuts, we used that money to purchase inflation bonds. So those are the two main steps that we took.
Excellent. So effectively, we risked up the fund through the event and got rid of some asset classes that you deployed pre the event that actually helped you as a circuit breaker, effectively the offshore currencies. As the currency weakened, you sold out of some of that stuff, you managed to lock in those returns, and you started buying some of the South African oversold assets. And what I saw, just sitting on your investment committee, was an incredible surge through May. I think at one point the fund was up 5 or 6%. So a huge move back up. And that's kind of the returns you would expect from an income fund over a year, but you generated a lot in 1 month. So there was an opportunity to really make quite a lot of money. So Mark, just as we conclude really around your fund, I remember when we set up this fund, we said that we would want to outperform the 5 top brand managers in South Africa over time. And, people ask, why would you set such elevated objectives for a manager? But that's just the way we think. If you don't operate at the highest echelons in the industry, don't do it at all. And your fund has, on a risk-adjusted basis, even nominally, outperformed those top guys now over quite a few years. What do you think, as a last comment, you do and Northstar does to ensure that that kind of return profile can persist over time? Is it a fund that clients can feel safe knowing that you're going to be a really good performing fixed income manager in the years ahead?
Hopefully we will be competitive over time, but the way that we position the fund is primarily is to make sure that we're exposed to good value assets. That's the one port of call, and what that means is that at a portfolio level, that we will generate a decent real return after costs. And so after costs, we would say that given the risks that we take, if we generate a 2% real return, then our job's done. And being very mindful of the risks that we take, that we deem that appropriate.
So currently the fund is yielding?
So currently the fund is yielding just under 7%. So we've just had a drop in inflation, which does impact the yields from the inflation bonds. But essentially the way to look at it is that we are on a 3.5% real yield now currently. Yeah. And with the average maturity of the assets that we hold, just over 4 years. So we are taking risk, but it's perfectly appropriate for where we sit in that risk spectrum. And that, we are aiming to achieve at least a 2% real over time. And particularly right now is quite a tough period for income funds because interest rates have fallen. And if you have a look at money markets returns, you're not getting much of a real return. So we're looking for that balance on a continuous basis.
So for our clients in the income fund, as we conclude, there's a 7% yield that is currently running at. It's a fund that's done high real returns, more than double what we ever said it would do from day one. Mark's done a phenomenal job. We run the fund at quite a low level of risk relative to competitors when we understand what they hold in their funds. We think there's a real space for a fund like this. It's smaller than the bigger funds out there, and it's outperforming the bigger funds. And we see no reason why we can't continue to do this in this framework that we've set, which is probably one of the key structures in Northstar. Is just the framework we set around investments. We totally focused on the investment side. We pure asset management, and we've done exactly that in an income space, generated a really high risk-adjusted return in a market with some giants out there that we're now outperforming. Well done, Mark. Thank you.
Great. Thanks.